Welcome to the Working with Private Lenders Guide, which is part of the financing course. Many real estate investors rely on private money. Private money, unlike institutional money, is money lent by individuals that are looking to get a better and/or more stable return on their money than they would with a bank or in the stock market. Private lenders come from all walks of life and their funds from a variety of other sources. Private money is an option for a real estate investor with bad credit, high debt-to-income ratios, or no money for a down payment. Even loan-qualified real estate investors use private money because private money is often a lot quicker and easier to obtain. Private lenders tend to be a lot more flexible in their terms than even some hard money lenders. They can be a lot cheaper and offer longer-term funding options too. However, there are private investors who will do hard money loans too. This guide discusses the ins and outs of working with private lenders. You will learn about different types of private investors, how to find and evaluate them, and how to present and structure your deals with them. What you should know. Before beginning this guide, you should understand basic principles and terminology used in real estate investing. Which properties to look for and why. Where you want to buy real estate. How to locate, motivate sellers. How to network. Basics of investment strategies. What you will learn. This guide covers the following learning objectives. Understand why you should work with private investors. Explain what a private investor is. List the advantages and disadvantages to using a private investor. Explain how to borrow funds the right way. List the types of private investor arrangements. Explain how to pick your private money investor. Describe how to plan and present your deal. Describe how to negotiate with the private investors. Explain how to maintain relationships with private lenders. Describe how to avoid SEC issues. Tips for success. If you are going to work with private investors, you will need to network to find these people. There are a lot of different ways to find these people. We want to share a few ideas here, but there are many more options and approaches discussed in the networking lesson of the marketing course. Tip number 1. Network at special events. You can network at specific events. You might go to the local real estate investor club, chamber of commerce, real estate professional association, or entrepreneur meetings. But networking events are not the only opportunities you have to network. There are opportunities to network everywhere you go, at the dentist office, at the gym, or even in a crowded store. Most of us miss these opportunities out of fear of being seen as too pushy or of developing a reputation as just another nagging salesperson. The amount and effectiveness of the networking that you do plays a very important role in the success or failure of your business. So how then do you network effectively without being perceived as a pest? First, stop worrying what others think. People will develop their own opinions about you no matter what you say or do. Tip number 2. Listen first, then talk. If you are the first one to speak, never start off talking about your own business first. Instead, ask about their business and listen carefully. Even if you don't have much interest in their business, be sure to ask them a question or two to let them know that you were listening. If they say anything remotely related to your own business services, wait until they are finished speaking, then point out the relation between their business and your own. Another option is to point out their investing goals and show them how your business can help them reach those rates of return. Then, after they have spoken about their success, begin explaining your business services. They will likely give you the same respect by listening attentively as you explain your business. If they ask you a legitimate question, then you know that they were listening and that you were able to network effectively. Exchange cards with them, always carry your business cards with you, and follow up with an email the very next day, stating how much you enjoyed learning about their business and reminding them of your business services, as well as any special promotions that you may have. Tip number 3. Offer your business card after you have finished telling your story. Offer them your generic business card and ask for theirs or their phone number or email so you can forward more information about this company to them. You may want to get a set of business cards with only your business name on it to use for these types of brief networking opportunities. This may seem a bit underhanded, but people are more apt to use the services of a company which has been referred by someone who has used the services and can vouch for their good work. The bottom line is, network, network, and network some more. It's a small world, and news travels fast, which is why networking is a key element in growing any business. After all, you never know who the person you meet is or who they really know. They might be your next private investor. What is a private lender? Private lenders, or investors, are generally middle-class people who have some extra funds to lend for real estate ventures but do not want the headaches and paperwork of managing tenants, negotiating with sellers and buyers, or repairing properties. They can be retired business people, corporate executives, professionals such as doctors, lawyers, or business owners, or even blue-collar workers, all looking for returns higher than the 3% to 5% they get at the banks. Private investors can acquire the money they lend you from a number of different sources: retirement funds, corporate or personal lines of credit, equity pulled from a business or real estate, personal or business loans, profit from a real estate or business liquidation, inheritance, lotteries, or court case winnings. Compared to hard money lenders, private lenders are generally a lot more flexible in their terms, the properties they will lend on, and how they are compensated. As long as they get the rate of return they are looking for and the deal seems sound and makes sense, they will invest in it. Keep in mind that not all private investors are the same. Private investors have different comfort levels for investing, and they may need different rates of return, may only fund certain types of properties or deals, they may lend for short or long terms, or they may have any other combination of other needs to do the deal. Most real estate investors lend money interest only to keep the monthly payment low. However, lenders will not reduce the principal over time as with an amortized loan. Educate and retain your private lenders. If your lenders don't know a lot about the real estate business or return on investment, you need to educate them that investing in real estate through you is a good risk. Explain to your potential investors that real estate is a solid investment that is secured by a deed of trust. Just remember is that while you can be as creative as you want, your investor has to agree to it. You can offer bonuses, percentages of partnerships, monthly stipends, additional collateral for their loan, and much more. As long as you keep your investors happy, you will be happy too. The goal is to retain the investor who offers you a low rate and offers it quickly and without a lot of red tape. Here's a list of possible private money lenders: family, friends, co-workers, retired real estate investors, retired entrepreneurs, doctors, dentists, lawyers, accountants, angel investors, tired landlords, promissory note investors, people with IRAs, 401ks, or other retirement funds, business owners with lines of credit or corporate credit, other real estate investors, people with equity in real estate or a business, fraternity brothers and sorority sisters, acquaintances, people on your Christmas card list, past or present employers and employees, customers, competitors, fellow church and synagogue members, people with common interests or hobbies, parents of your children's friends, referrals from everyone above, anyone else with access to sums of money. People with good credit can get the loan for your deal and split profits or great return. Types of private investor arrangements. There are 4 main financing options when it comes to raising money from friends, relatives, and other private investors: gifts, loans, equity investments, and joint ventures. Learn about each one so that you can make the best choice for you and your potential lender. Gifts from family and friends. A gift is the simplest way of obtaining capital. You have no ongoing obligation to the giver, although you should thank the person and make an effort to maintain good relations. A friend or family member might offer a gift of money to help you get started, or you might jumpstart the process by asking. Though it might seem impolite to ask someone for a gift of money when you're starting a business, it makes sense. In the case of real estate investing, traditional lenders do not like seeing a gift. Make sure the gift is made to your company, which then loans you the money, or if it is enough money to buy the property outright, just pay cash for it and do not worry about the rest. Documenting a gift. To document a gift, all that's necessary is a letter explaining that the money is a gift. The giver should keep a copy for tax purposes, to assure the IRS that the transfer wasn't an interest-free loan. You should keep a copy as well. You may receive up to a certain gift amount each year from any one person as a tax-free gift. This can be a great way for a relative to offset their taxable income and give you parts of your inheritance while they are still alive. If you receive more than that certain gift amount, the giver must file a gift tax return, IRS Form 7-0-9, U.S. gift tax return, for the amount given over that year's predetermined gift amount. Documenting the loan. For your sake and the sake of your lender, it's best to set up every loan the way a bank would, with a signed agreement, called a promissory note, and a repayment schedule. Following these business standards will increase prospective lenders' confidence, and these documents will protect your lender from having the IRS treat the loan as a gift. The written documents should spell out when and how you're expected to repay the money, including what to do if the payment is late. Once you've signed the promissory note, it's legally binding. Choosing an interest rate. People who lend you money are often looking for a decent interest rate. A respectable interest rate, similar to what your lender would earn on a savings account or CD, may make your lender happier about the whole arrangement. For prospective lenders who aren't that close to you, offering an interest rate that exceeds what they'd earn elsewhere is a great way to attract their attention. Considerations when getting a private loan. If you are considering a private loan arrangement, understand that you'll have to regularly manage the loan, usually by making monthly payments. This might be difficult if your business isn't making money. Of course, your private lender is likely to be more flexible than a bank if you can't meet your repayment obligations. But you should seriously consider whether you and your business can handle these monthly payments before signing onto a loan. For example, Carrie was experienced in investing in the stock market, but she did not know anything about real estate. She had recently inherited some money from her great-aunt and was looking for a new way to invest it. Carrie spoke with her accountant Bill about her desire to invest in real estate and asked for his advice. Bill referred her to Tom, who was a very experienced foreclosure real estate investor, who was always looking for new private money sources. Carrie called Bill and they hit off from the start. Carrie told Bill that she wasn't interested in learning about real estate investing, she just wanted to make money from it. They struck an agreement and Carrie funded a total of 25 deals for Bill over a 4-year period of time. Bill and Carrie structured a loan each time he borrowed her money. The terms varied from time to time with each deal, but it was always a win-win for each party. Together they made a lot of money. Equity investors. A third way to raise business capital is to sell shares in your business to an equity investor. Although many businesses seek out professional equity investors, your friends and family members can also become equity investors in your business. How equity investments work. Unlike a lender, who temporarily provides you with money to operate your business, equity investors actually buy a piece of your business. They become your co-owners or shareholders and share in the fortunes and misfortunes of your business. Obviously, you should choose these people wisely, as they will have some say in how you run your business. You should maintain a majority ownership interest in your business so you can have the final say in most business decisions. When raising money for your business, you'll need to compensate your investors for the risk they've agreed to take on. Share ownership in the business. Comply with securities laws. Put all these agreements into a legal document unique to your financing situation, probably with the help of an attorney. Compensating and protecting equity investors. Equity investors take on a high level of risk, often investing with no guarantee that your real estate deals will make money. Your investors should understand and accept that they are not guaranteed to get their money back. To make the risk worthwhile, equity investors stand to win big if your business succeeds. If your business grows fast, investors will earn a lot more than they would have by merely making you a loan and collecting interest. For example, if a friend loans you $10,000 and you repay it at 6% over 2 years, your friend will make $637 on the loan. If a friend buys a 10% stake in your $100,000 company, and it then becomes a $500,000 company, your friend's investment will have earned far more than $637. Equity investors protect themselves. Equity investors often take steps to protect themselves as much as possible from business failure by making sure that they stand a better chance than any other investor of getting their money back if the business goes belly up. They draw up legal documents that ensure they will be able to collect a return. Documenting an equity investment. You'll need to create an equity purchase agreement and other documents to formalize an equity investment in your business. This paperwork can be complicated and will determine who owns and controls your company, so you will probably want to consult an attorney. Also, depending on how many investors you take in and how much money you raise, you may also need to comply with federal and state securities laws. Finally, you'll want to learn about how having investors will affect how you file your taxes, and you should inform your investors of the tax consequences of their investments. Joint ventures. Joint venture partnerships, commonly known as JVs, are formed between 2 or more people to invest in a specific business or property opportunity, often between someone who lacks the time or expertise to invest, often referred to as the money partner, and an expert, often referred to as the finder, who is looking to leverage his or her experience by providing the knowledge, skill, and work needed to create a profitable investment. JVs do not have to be long-term or involve each party in all deals, but can be done on a per-deal basis, or they can be a company that invests only in certain types of deals. The money partner may be silent and simply provide the capital needed to get started, while the real estate expert conducts all the research, tenanting, market timing, and day-to-day property management. JVs are a good way for less experienced investors to start. The risks are reduced and beginners can grow their money while learning how to invest, making a decent profit in the process. Credit partners are also good people to enter into joint ventures with as well. When you work with a credit partner, you have them qualify for a loan, and once you find and structure the deal, you use their credit to obtain financing. You then agree how you will split the proceeds after the sale of the property. How joint venture partnership investments benefit the money partner. Leverage experience. Joint venture investments help the money partner realize more value for their money and time because they can leverage the knowledge and expertise that an expert brings to the table. Real estate experts can define a location and strategy for their investments and analyze the market to suit the money partner's future needs. Sense of security. Joint ventures provide a sense of security. If the joint investor is an expert with a solid, reputable background in real estate investing and a good investment portfolio, this reduces risk. Exit strategy needed. Before a private investor invests in your business, they will expect to see an exit strategy. Don't be surprised if your investor wants a timeframe set for them to get their money back. Borrowing funds the right way. So how can eager real estate investors keep their personal relationships from going belly up when borrowing funds from relatives and friends? Here are a few tips to consider. Accept rejection as part of the process. Real estate investors shouldn't let themselves get offended if family and friends are unwilling to hand over their hard-earned cash. Treating potential lenders professionally is a must, and this includes accepting rejection. Real estate investors undoubtedly are not interested in being manipulated or guilt-tripped by the friends and family who lend them money, so they should extend the same courtesy to those from whom they solicit funds. Consider equity. One way to safeguard the relationship at a cost is to tie financing to equity rather than a loan, according to Incorporated magazine. It provides more leverage to friends and family who may offer their money to the business, but please note that it may put real estate investors in the uncomfortable position of having to dilute ownership in their own company. Structure the loan professionally. Once a friend or family member has agreed to provide money for the deal, outlining the loan terms and repayment plan in official documents and having both parties sign, which reduces the potential for a misunderstanding. When structuring repayment plans, consider paying back the amount gradually rather than in a lump sum payment. This can safeguard you if you are not able to pay the whole amount on the date due. Finding private investors. Many investors think that the lack of money is what stops them from closing a deal. This is a myth. Understand that money is never an issue. If the deal is right, the money will come. Simply think creatively, go to the source of funds, and ask for money. The worst that can happen is you get a no. Each no only places you closer to yes. You might find private investors in the least likely places or circumstances. Contractors and vendors. Contractors can be a sort of private lender. Some contractors can work with you and not expect any money until you close on the property they made repairs on. Or they can work a deal with you on labor costs later, perhaps after closing. Whenever anyone lends money or resources to you, consider that source an asset and partner. Extended payments from a vendor are another great source of capital for a small business. If you don't abuse your creditors, they will have an interest in your success. Creditors can include paint supply stores, door distributors, wholesale flooring companies, etc. Other contractors may finance the fix-up costs for you, to be paid upon refinance or sale of the property. They charge a higher price, but it's not your available cash that's paying for fix-up. Anyone who has a vested interest in making a project happen and is willing to roll the dice with you, for whatever reason, can be considered a private investor. Your lawyer and CPA. You may never ask your lawyer or CPA for money, but you might ask them for referrals. If you don't want to ask them for referrals directly, you might try a more sheepish approach. Consider putting together a prospectus that focuses on your local market, with forecasts on the real estate market and the types of returns that can be made on different types of deals in the local area. Of course, the more you can reference from credible sources and use actual tangible properties and real numbers, the more appealing it will be. It can be a simple 10-page portfolio packet that contains pictures, both before and after the renovation, of several houses that you have done recently, purchase checks and also the checks from the sales of these houses, and printouts from your accounting software to show exactly how much you spent and where it went. Next, write a letter of introduction to put on top of the packet, explaining who you are, why you need private money, the rates you will pay private investors, when they will get paid, how their investment would be secured, and so forth. Ask your lawyer or CPA to review the packet and make sure you are offering information within the confines of the law. It can be a good way to educate them about what you do and how you do it and find out if your portfolio packet is legal or not. They may even refer other people to you. County records. You can search through county records to find people who have a private mortgage in their own name and contact them because they may have more money to lend. Also, look for trusts, LLCs, or other individuals who seem to buying a lot of foreclosure properties or income-generating properties. These will most likely be other investors. They might have enough funds that they might want to joint venture, partner, or offer their private funds in a loan to you. You can also look for properties that have been inherited and contact the executor of the estate and see if they want to invest or know if the heirs want to invest. Send them a letter or portfolio packet telling them about your ability, or better yet, call them. Web advertisements. Look for web advertisements or use the web. Do a search on Google or Yahoo for real estate funding or venture financing. On the search results pages, little ads should appear at the top or along the right-hand side, put there by investors looking for opportunities. Just click on those ads and contact the investors. They want to hear from you. Just be cautious when using these resources for funds. Entrepreneur forums. Search the web for entrepreneur forums and networking sites. Many times they will allow you to post your need for money or have people posting the money they have to lend. You will find many websites if you search the web for the keywords entrepreneur plus networking. Social networking opportunities. Social networking websites offer some of the same opportunities as the entrepreneur networking websites do. You just have to join groups and do keywords searched in these networks to find people who are interested in investing their private funds in deals. Keep in mind that the person you're looking for does not have to be someone who is already looking for a real estate investment. It could be anyone looking for an investment and has money to lend. You can even ask friends or people within your network for names of people who are willing to lend money. Peer-to-peer, P2P, lending. In a peer-to-peer investment contract, investors contribute money to an enterprise with the expectation of receiving a return as a result of the managerial efforts of someone other than themselves. P2P lending is a relatively new phenomenon, but already it has originated hundreds of billions of dollars in loans and connected millions of private borrowers and lenders. There are several major players that appear to continually stand out above the rest. Over time, P2P lending sites have had to adjust their business models in order to comply with relevant securities laws. The people who conduct these transactions need to be properly licensed by the SEC in order to do so. Because of the way in which peer-to-peer lending companies structure and distribute their loans, they now need to receive this licensure. Here are a few P2P lender networks you might investigate. Prosper, Lending Club, Zopa, Virgin Money. Private lending group presentations. A private lending presentation involves getting 5 to 20 people in a room and doing a group presentation where you lay out the details and benefits of your private lending program. This may not be for everyone, depending on your comfort level of talking in front of a group of people. But there is a big advantage of doing group meetings. When people start to ask questions and tell positive stories, a certain level of confidence can arise that can have a very powerful effect on the other attendees. One-on-one meetings. If you are not comfortable with group meetings, one-on-one meetings are a great alternative. We generally recommend a breakfast meeting in a quiet restaurant where you can have 15 to 45 minutes of time with your prospect. Like the group meeting, you need to lay out your private lending program's details and benefits. Property portfolio you can mail. If the potential prospect is out of town, you will need a good portfolio packet you can send in the mail. It is very important to follow up 2 or 3 days after you send the package to see if they have any questions. Even if they do not participate right away, keep in contact and they may invest some time down the road after a number of follow-up contacts. Existing private lenders. If you already have a private lender or lenders, be sure to ask them if they would like to participate in more deals on a regular basis. Most investors only put up a very small investment to start with and wait to see how things turn out before giving you more money. So keep asking and do what you say you are going to do, and they will begin to trust you. As the relationship grows, they may be more willing to invest larger and larger sums of money, which will grow your real estate investing business that much faster. Angel investors. When your personal network is tapped out, the next group to consider are angel investors. These are independent individuals who invest in the early stages of private business ventures. Angel investors are usually high net worth individuals who qualify as accredited investors, so pursuing them doesn't typically create complications with SEC rules on solicitation. Typical angel investments range from $25,000 to $100,000. Having an inside contact in an angel investor group or an introduction through a mutual friend may improve the chances of success. You can usually find local groups through a quick Google search, and university entrepreneur programs as another helpful avenue. Before presenting a pitch to an angel investor or entrepreneur group, you should go and listen to pitches that are being offered at an angel investor or entrepreneur meeting and then try to get on their schedule and present. Again, your portfolio packet will help the angel investors see you as a legitimate business and a worthwhile risk. Develop a 30-second commercial. Network with everyone you know and develop a 30-second commercial that might go like this. Are you getting a safe return on your idle cash or retirement funds? No? Well, we pay cash for houses and we use private lenders to fund our deals. We pay returns on notes secured by local real estate. If you are not getting that type of predictable return on your money, I'll be glad to get you the details. We occasionally hold a free luncheon for potential investors, or I could also sit down with you at your convenience and show you how it works. If you like what you hear, simply let me know how much you're looking to invest and how long you can have your funds tied up. I'll put you on my list and look for an investment opportunity that meets your needs. When I find one, I will call you. At that time you can pass or play. There's no obligation. Obviously, you will want to mold this example to meet your own personality and style of talking to other people. Local REIA newsletter and Craigslist ads. From time to time you will find private investors advertising that they are looking for deals to invest in or have money to lend. Local real estate investment club. You can network there or at the Chamber of Commerce or entrepreneur clubs to find private investors who might be interested in investing with you. It would be great if we could advertise for these people, but to comply with SEC rules we are restricted on what we can say and how we can attract these private investors. You will want to review these laws and understand what you can and cannot do to find your private investors. We recommend that you seek local legal counsel on this matter. Planning and presenting your deal. Funding a new startup is not that hard if the idea is sound, however. Do not expect to walk in and have a quick chat and expect a check in your back pocket on your way out the door. You are typically wise to do a feasibility study and provide supporting data that can easily be verified. To get the go-ahead for seed capital from private investors, you need to keep in mind that their motivation is first to preserve their capital and second, to make money. A private investor will first assess your business concept and you for the likelihood that she will get their capital back before they consider the potential rewards. Once you find a group of potential lenders, set up a meeting with them to discuss your plans and offer your portfolio packet proving what you can do, how you do it, and how you can put their money to work for them. If you have a solid plan, you will instill confidence in them and they will be more inclined to loan you their hard-earned dollars. Other items to consider. Before you approach new private investors, consider evaluating the following items. Do phone screening before spending time in person. Know how something is going to benefit a potential client before you go and talk to them. Be prepared and anticipate their questions. Assume you're going to get the money. Establish your prices fairly and firmly. Estimate carefully your own value. Raise your price by the amount of time you have to deal with a project. Be careful to assess how flexible they can be. Presenting to your investors. Most times you only get one chance to give a persuasive pitch, so you will want to be prepared and confident and include the following in your presentation. Executive summary. This should be a compelling one-page document that inspires investors to agree to a meeting. Slideshow. Present your information in a slideshow or PowerPoint presentation. It should briefly and concisely convey the opportunity and financial model to investors. You can also provide a synopsis of your presentation and your portfolio packet that they can take home. Financial model. If you don't have experience developing a financial model, get another team member's help. It's important to put some metrics before your investor so they can understand the economic drivers in the business and how this deal will make money. Show them the local real estate cycles, appreciation rates, average rent amounts, days on market, etc. What investors look for in your presentation. Many investors look for the character of the real estate investor and a strong determination to succeed when deciding whether or not to fund the deal. Character traits. Confidence, consistency, and integrity are three components real estate investors should strive to convey when they are seeking funding from private investors. Private investor decisions are also influenced by charm, charisma, principles, timing, location, everything you can imagine. Track record. A significant personal investment into the project, positive letters of reference, and a track record of successful projects are compelling ways to convince outside sources to support the project. A financial commitment demonstrates that the real estate investor has a personal stake in the project's success and will suffer if it fails. Or they look for a good track record behind you. Be organized and prepared. When presenting a project, it is crucial to be organized, prepare for questions, and provide references. If no references from past deals are available, then professional colleagues in the industry might suffice depending on the private investor. Make sure your business plan is up to date and that you have your portfolio packet. Don't appear desperate. You can't show that you need the money too much. Investors can smell desperation, and if they do, they might run. Invest enough time. Courting investors requires a lot of time and commitment and negotiating and lunches and dinners and time away from family. Getting to know these investors who really sort of become like family. Keeping their interest. Very few people like surprises, especially investors. Send them quarterly or biannual progress reports similar to those public companies issue to shareholders. Additionally, provide information about expected returns and projected timelines that are set to meet goals. You can send project timelines and costs to date to them as well. Picking your private money investor. Many real estate investors feel like they should be able to find private investors in a few weeks. Worse yet, some expect to find them in a matter of days. Realistically, your funding search may take months or even years. So if you anticipate that you'll need deal funding anytime in the near future, start the search now. There are several complicating factors that you may encounter on your search for deal funding. In any successful relationship, you have to have three things: common goals, compatible styles, ability to communicate. The investment relationship is like a marriage. It is not going to be flawless, and each party is going to bring their quirks into the relationship. You really need to find out about your private money investor. The relationship that you develop between you and your private investors will hopefully be a long and enduring one. However, this is not always the case, as people have varying investment objectives and financial needs in their lives that might change their focus or investment criteria. Questions to ask potential lenders. Ask them a few of the following questions to help you decide if they are a good money partner and to determine whether your styles and goals are compatible. What is their comfort level in risk-taking? What is their money doing now? What rate of return do they expect as a minimum? What is their experience level with real estate? How soon do they want their money back? What is their hot button regarding investments? What are they afraid of? What will secure their comfort level? How active or passive do they wish to be? Questions to ask yourself. You might ask yourself these questions. What are you looking for in money investors? What do you want from them? What do you want them to be like? What's important in your evaluation of them? Different types of private investors. There are a couple different types of private investors that you can look into for funding. Wrong partnership profile. The wrong partnership profile includes dishonesty. Avoid someone who has a pattern of dishonesty, which may be subtle but could include little misrepresentations and small white lies about numerous aspects of business and life. Many good people do not do their due diligence on a prospective partner and are surprised later to find out that their partner lacks integrity and lies about many things. You have to dig here to find out if the person has integrity. A pretty big sign that they do not is when they don't completely answer your probing questions into their own business affairs and financial history. A partner who is not transparent can be dangerous. Dysfunctionality. Someone who is dysfunctional in areas that are important in a successful real estate joint venture. You have to be a student of human behavior to some degree to be able to choose the right partner, or to avoid choosing the wrong partner. That is true of being able to recognize that someone is not what they seem, or that has a personality you don't want to work with. But you cannot go by gut feeling alone. Gut feelings only are helpful if there is a level of maturity in understanding human behavior. Other minuses. Here are some other negatives that you should look out for. Nothing to contribute to the partnership. Laziness. All talk. Overscheduled and too busy with a million other things. These people will never actually have the time to contribute to your partnership. Personal baggage. This can include problematic business relationships of their own, in example, creditors and recorded judgments, and even serious relationship. How to choose the right partner. You should look for the following when choosing a partner. Complementary strengths. Find someone who is of a different personality strength than you. If you are a strong leader, find someone who is a good follower. If you are strong in the visionary area, find someone who is detail-oriented. This way your strengths and weaknesses will meld and harmonize together. Partner with steady income. Seek out a partner who has a steady income and cash reserves. After all, you are seeking a partner to help get you launched, and cash will be needed. If they don't have much cash, they should at least have great credit and a willingness to use it. Common goals. Have the same end goals. Are you planning to buy and hold? Or rehab? Or flip? Are you looking to sell to investors or end buyers? Nothing will work if you are headed in separate directions. Morals a match. Your morals and values must be a good match. If your intention is to build a strong reputation of high integrity, you don't want to partner with someone who thinks nothing of cutting a few corners. Integrity. You want someone who is honest and who has integrity, which is no small challenge. A poll taken a couple of years ago indicated that 50% of all people in American society admit to regularly lying. You don't need someone who is perfect. There is no such person. But you do want honesty. Past failures are okay, provided this person brings valuable contributions to the partnership. Your partners should be people you respect and admire. Common ground. Each partner should be someone with whom you feel a connection, someone who is a kindred spirit. Obviously, you need to get to know someone before you jump into a partnership with them. Knowledge and experience. And last but not least, your partner should be someone who brings valuable knowledge and experience into the venture. The knowledge and experience of the individuals you bring into the partnership will depend on the venture. For example, if your partnership is to develop raw property for sale to builders or other buyers, you would want credentials in that area. Example, developing raw property for sale. If you were developing a raw property for sale, you might need the following experts. Excavator who has experience sufficient to do the dirt work. Engineer surveyor with sufficient experience to be able to do all the engineering and surveying required for the platting work. Another engineer, if not the same one, who can do all of the plat drafting and submissions to the city or county. Utilities man who can install the utilities properly and to code, power, sewer, cable, phone. An asphalt company that can pour beautiful roads throughout the project. Real estate lawyer who knows real estate and all the contracts and negotiations involved. Realtor who can sell the lots to builders or individuals. Person or persons with financial resources, both cash and credit. Buying single-family homes for rental or resale. If you are buying single-family homes for rental or resale, you might need the following experts. Experienced inspector or builder who knows how to inspect. Experienced contractor builder who can do great rehab work. Real estate lawyer who knows real estate and all the contracts and negotiations involved. Realtor who can buy and sell for the partnership. Person or persons with financial resources, both cash and credit. Negotiating the terms of your partnership. Once you've found and chosen your interested investor, the negotiation process begins. This can take several iterations to get right and may ultimately never work out. You have to prepare the property profile before your meeting, which includes all of the items necessary for the investor to evaluate the deal effectively. This step can be worked on while you are still making your initial search for potential investors. Once the investor has expressed interest, you'll need to negotiate the amount of funding required. This may take several meetings. When this is settled, you'll get the term sheet. The term sheet will ultimately need approval from both parties. This will take some massaging before it finally goes through. If all goes well, you've successfully landed funding. Unfortunately, most of these meetings don't result in a successful match, and you may have to go through this process dozens of times before you find the ideal partnership. Common mistakes. Here are some common mistakes that people make when negotiating and acquiring funds from private investors. Not using an attorney. Not having a backup plan, ideally, multiple backup plans. Assuming investors are on board before they make a financial or legal commitment. Being deterred by rejections. Acting too desperate. Lacking confidence. Not allowing process enough time, last minute. Fixed components in a standard partnership agreement. Any agreement between partners is really an agreement built of component parts, based on the goals and needs of the partners involved. It's a business venture, so you've got to analyze the components. Some components are fixed, and some are variable, but the sum total must be fair and meet the needs of both parties. Now, there are some certain fixed components in the standard partnership agreement which don't need negotiating. Here are some areas to cover / questions to ask within a standard partnership agreement. What is it? A single-family house, an apartment building, a duplex? It needs to be stated. What is the purpose of the venture? To buy it and wholesale it, to fix it and sell it for retail, to hold for rental? What is the business address? What is the effective date of the venture going to be? Where are the books held and who will handle this, and how often will they notify the partners of what is going on with this? What bank account is going to be used and who is authorized to access it? What is the intended result? Are you going to have a statement that there's a profit or a guarantee, or are you going to purposely say there is no guarantee? What is the responsibility of the parties? Who is going to do what? What is the mechanism for changing the agreement? Are you ever going to change it, and if so, what does it take to do it? What is the mechanism for handling the dissent of the parties? And if you disagree, what are you going to do? What is the mechanism for dissolution? Creating favorable terms for all parties. You need to negotiate the terms of your partnership before you buy any properties. If the two partners are relatively knowledgeable real estate people, you'll probably have different attributes or complementary skills so that you can join forces and thus reach the same goals. In all likelihood, that money partner doesn't want to know too many of the details, and may not want to be bothered with it all. They may want just the results and positive reports along the way. No 50-50 partnership. Never agree to a 50-50 partnership, if you are seeking a partner, then it is your deal and your business. Create a 51-49 partnership. Otherwise, you will have a two-headed monster. When you come to an impasse, you will call the shots. Adhere to guidelines. Write out the guidelines and stick by them. Part of these guidelines will be your separate roles in the business. Agree ahead of time of who will do what. Review these guidelines periodically. If one area is not working well, adjust accordingly. Formal setup. Your partnership may be set up formally as a shared LLC, or you may simply create a written agreement. Either way, set it up so you can make an easy exit. Make a list. In any case, the negotiated agreement has to provide that each partner receives the particular benefits that make sense for them individually. Sometimes it may help to use a list and sort out the benefits. Who gets title? All real estate has a bundle of privileges and rights, and one of them is that whoever has the title to the property has the tax benefits. Some of your equity partners or joint ventures need a tax benefit, so it might be negotiated that it is in their name. Sometimes they want anonymity, so whose name would it be in? If you don't want your name on the title, it could be a trust, or a corporation, or some other entity. In other words, whoever has the title of ownership has a benefit, so that's one of the things you work out on your list of variables on your partnership agreement. Tax benefits. Tax benefits must equal 100%, but don't have to be apportioned between the partners the same as ownership. Length of holding. This can be long or short. The agreement needs to state clearly the negotiated timetable for this venture. This is one component quite likely to be amended. Whose money and in what proportion? Who is contributing what and when is a basic issue for partners to negotiate. Is there payment up front? It costs money to find something and to manage it as well. You may have structured arrangements as a deal maker where sometimes you receive money up front and sometimes not. And that will vary, depending on the objectives of the partners. Who gets a positive cash flow? Is the cash flow distributed, and in what proportion? As a managing partner, you could take all of it, if there is any. For instance, if you have the management responsibility for a multiple unit, you could turn that responsibility into a benefit for yourself. If you install a Coke machine or washers and dryers or telephones, you could retain the income from those additions. Again, it's all up to you. Cash distributions. How will cash distributions be made? Will it be every 6 months, once a year, once a month? Handling negative cash flow. Who will handle the negative cash flow, and in what proportion? This can vary by property, by partner, or by deal. There might be negative cash flow that you didn't expect. Will one of the partners actually benefit by having a negative cash flow? Rewarding non-capital contributions. How and when will the deal maker be paid? Money is not the only component or way someone can be rewarded for their time and experience. Who makes the decisions? Who is involved and when are they involved are major questions that need to be answered. Are they a silent partner or an active member of the real estate decisions you make? Monthly mortgage payment liability. Another major consideration is the mortgage liability. What if the property has a negative cash flow because of a vacancy? Does that mean that the operating partner is going to come up with the funds? Or should it be the owner on title? Or should it come out of something else? You need to think that through. Cash distribution after a resale. If you resold it on a wrap, who is going to manage the wrap? When is the money partner going to get their money and how much? Involving others when a property isn't resold. If a property doesn't resell within your set time frame, will you involve someone else, like a real estate agent? Does the partner have the right to say you didn't perform? And whose share is the cost going to come out of? This falls into the area of performance. Did you do what you said you were going to do? And if you didn't, why? Have you communicated to your partner what the problems are? How much maintenance reserve? If you are the managing partner and you really don't want them to do anything, that's perfectly okay, if that's what you agree on. What happens if that level of partner involvement changes? What can you do? Communication. This could possibly be the most important factor you'll be determining. How will you communicate? Will it be in writing, through monthly or quarterly meetings, or through weekly phone updates? You and your partner have to determine what mechanism is going to make you feel comfortable. Partnerships can be going along great, but what happens when things get rough? You need to go into it with the idea that if there's a problem, what are we going to do? That is a lot different than what are you going to do to get me out of this mess? It's got to be a we situation, or you're going to wind up in court. Then who wins? The attorneys get some money. Always try to communicate and get things worked out without resorting to legal maneuvers, in the worst case. Issues that can end or change partnerships. Here are a few outstanding circumstances which can change or possibly even end your partnership. Death or disability to either party. Disabling lawsuit. Bankruptcy. Divorce. Change in circumstances on the property itself. Should any of these circumstances occur, it is in the partnership's best interest to discuss, if possible, all aspects of the partnership so that both people understand each other and so there is no confusion. Always remember, a good pre-existing relationship does not eliminate the need for good paperwork. Dissolving a partnership due to problems. If you need to dissolve an incomplete venture relationship, remember these 8 points. Be business-like. Acknowledge any problems. Attempt to be creative in solving the conflict without resorting to dueling attorneys. Do not point fingers or blame. Try to figure out a win-win situation for both parties, or at least a fair situation for both. Renegotiate a way out of the situation. Don't burn bridges or create enemies. Determine if pursuing the conflict resolution clauses in your agreement are appropriate. Maintaining relationships with private lenders. Maintaining your relationship with your private lenders is important not only for the relationship itself, but also to preserve your future networking opportunities. Successful projects and satisfied investors will spread the word and facilitate future opportunities. If you deliver above and beyond what was expected and/or agreed on, you have a better chance of attracting more future capital. How to keep your partner happy. Here are some tips to keep your private lender partner happy. Show your appreciation and acknowledge your partner's role, whatever it is. Communicate more often rather than less often, both good and bad news. Ask your partner for feedback, ideas, and perspective. Protect each other legally. Protect the venture from your own personal tribulations. Do what you say you are going to do. Don't expect too much too soon, or promise it without delivering it. Don't ever disclose the specifics of your partnership arrangement with anybody else. Respect the privacy of your partner. Even disclosing who you are in a partnership with is truly no one else's business. If things go wrong, don't badmouth your partner to others. Avoiding SEC issues. Raising funds from outside sources can be tricky. The Securities and Exchange Commission has regulations that both protect and restrict average investors. For instance, you can raise money to buy real estate investments through private investors, but you cannot publicly solicit for private investors nor can you guarantee any rate of return. Private investors, however, can advertise the money they have available. Consult an attorney. Please remember, the advice contained herein is not from attorneys. The information offered here is for educational purposes only and should not be considered legal advice. We merely want to make you aware that there are SEC rulings and restrictions so that you can operate within the confines of the SEC law. Remember also that each state has different rules and that you should know what the rules are in your state. Be sure to do research for your state and federal SEC laws to avoid issues with the SEC, or seek counsel from an attorney who is well-versed in SEC regulations. Becoming a private lender yourself. There are many ways you can secure the funds to become the bank for other investors. Most of the ways do not require that you have a lot of money or access to a lot of money, although having a large amount of money never hurts. If you are in a market where a single-family residence is $10,000 to $30,000 on average, you could be a private investor with a few $1,000s. However, if you are planning on being a private investor on large commercial properties such as large apartment complexes, then you will probably need at least tens, but more realistically hundreds of thousands of dollars available. Different sources of funds. Private investors typically have different sources for the funds they lend out. These include cash, borrowing against property, personal lines of credit, personal loans, business lines of credit, and self-directed IRAs. A few private lenders even use a pool of smaller investors who lend them the money that they in turn can lend out. Be very careful if you begin lending out other people's money. However, seek legal advice before doing this, as there are very specific SEC laws you will have to abide by or risk legal and financial troubles. Cash. One of the easiest ways to start private lending is to have the cash in the bank. Your cash will make tons more interest funding short-term private investor deals than it will sitting in the bank. Where might your cash come from? If you used a fast cash investment strategy, you might have made money from bird dogging, assigning contracts, or from buying and selling a property quickly. You can in turn do private investor loans for the same people you did bird dogging or assignment of contracts with, or you can develop a network of investors who need money to buy, fix, and resell property. Borrow against your own property. Depending on what is going on with the conventional lending world, you may be able to refinance a property or two that you own and loan the funds to private investors. You might be able to utilize home equity lines of credit or home equity loans. Home equity loan. A home equity loan is one in which the borrower uses the equity in their home as collateral. Typically, home equity loans are referred to as second mortgages because they are backed by the value of the property, just like a traditional mortgage. A more formal definition is a loan secured by a second mortgage on one's principal residence, generally to be used for some non-housing expenditure. Home equity loans became popular in the latter 1980s as a way to finance purchases or consolidate existing debts while retaining tax-deductible status for the interest paid on the loan. Personal lines of credit. If you have or can qualify for a PLOC or a personal loan, you might consider using these funds to lend to private investors. This is a revolving line of credit that can be used, paid off, and used again. With unsecured lines of credit, you are not offering any collateral, unlike a home equity line of credit, which offers funds secured by a piece of property. Often, this instrument is associated with some sort of credit card, where you qualify for a certain amount of money that you can use as you need. If you do not use it, in most cases you will not need to pay any fees. Sometimes they can close the line of credit due to inactivity or charge you fees for not using the credit. You will make monthly payments on the amount outstanding plus interest, which can vary or be fixed. Be aware of the fees associated with doing cash advances, fund transfers into a checking account, or using checks to draw money from this line of credit. One benefit of personal lines of credit is that the lender might increase your limit from time to time without even talking with you, or you may be able to request a line of credit increase. Secured lines of credit. Some banks may offer secured lines of credit, which allow you to borrow more money than with a personal line of credit because they are secured with a savings account, CD, or investments. We recommend obtaining lines of credit from a local bank or credit union because they will most likely offer a fixed rate and no time restrictions on using the money. Sometimes they may waive or reduced fees for accessing your funds. Personal loans. A personal loan is an unsecured loan that you qualify for based on your credit, payment history, and income. Once the loan has matured, it needs to be paid off or you will incur more fees or a higher interest rate. This is not a revolving or open line of credit, like a personal line of credit, so if you need more money again, you must submit a new loan application. Be aware of any prepayment penalty fees as well. Obviously, you must make sure that the rate that you are borrowing the funds at is lower than the interest rate you are charging your private investors. Also, make sure you have a locked interest rate or understand the time frame in which the rate is locked so you can have your private investor pay their loan off to you in time. You may also want to build in penalty fees into your private investor loans to cover your costs if the private investor fails to pay you off in time. Business lines of credit. Business lines of credit have features similar to personal lines of credit except that they are separate from you and your credit. If you obtain the right type of credit line, your name will not be tied to it, and it will not show up on your credit report. With business lines of credit, you will not be the one qualifying for the line of credit, your business will. Self-directed IRAs. Some people use self-directed IRAs to fund private investor loan transactions. Obviously, there is risk in doing these deals or else everyone would be doing them, so you might want to consider whether you feel comfortable with your retirement funds potentially being jeopardized by a deal that goes bad. You might consider dividing up the funds into different self-directed IRA accounts and investing it that way, so you do not run the risk of it all being compromised at one time. Of course, you would want to talk with the custodian of your self-directed IRA to determine how you can accomplish this or what your options are at that point. It will reduce your risk exposure quite a bit if you can accomplish this successfully. In the Retirement Funds and Self-Directed IRAs lesson, we discuss how self-directed IRAs can be used to invest in real estate. Action items. Review this module to determine if working with a private lender is still feasible for you. Utilize the resources mentioned in this guide to find private investors who meet your investment needs and criteria. Contact and screen these private investors. Prepare a property portfolio that you can send to them or present to them at a group meeting. Maintain contact with these investors on a regular basis. Identify at least 10 motivated property sellers and then narrow the list down to 5 properties that you can evaluate, and develop a property portfolio on each and present it to the best matched private investors. Once the investors agree to fund you deal or deals, present your offer on those properties you have funding for. Summary. New real estate investors often have a hard time finding funding for their real estate deals. Credit or money issues can hinder them from acquiring funds in the traditional way, so they sometimes need to pursue finding funding in non-traditional ways. Working with private investors is one of those ways. Private investors have less stringent loan terms, deal criteria, and paperwork. They typically will be able to fund deals faster too. They are open to more creative deal structures to help you make the deal work. They might allow you to borrow money deal to deal or let the money sit within a company that you can use to buy, fix, sell, or rent property. Once you find these investors, they will more than repay you for the hard work you did to find them. Persistence is key to finding and securing private investors who will help you fund your deals. And finally, if you maintain a trusting with them, you can have a continuous source to build your real estate wealth without affecting your credit score or dealing with the waiting or paperwork involved with traditional lenders. Coming up. This guide is just one of many financing options you have to fund your real estate deals. Other financing lessons to review include building corporate credit, understanding retirement funds, and self-directed IRAs, and working with a hard money lender. You should revisit the networking lesson too, as it will help you understand how to network with others to receive referrals and obtain sources for funds and deals. The negotiating lesson can help you refine your negotiation skills so you can negotiate effectively with your private investors on the terms and conditions for your deals.